Well, we've done some more research on this. I think I've prepared 4 slides here in this respect. What you're going to see is the fiscal balance in inflation targeting countries. So this is the mean. So this is just to better show the trends. These are the 5 early adopters of inflation targeting: Australia, Canada, New Zealand, Sweden, and UK. And what you see, always the shaded area indicates the introduction of inflation targeting. So what you see that after the introduction, fiscal policy has been kind of still excessively expansionary. So fiscal policy have been running deficit. But in all 5 countries, after this transition period of about 1 or 2 years after the introduction, fiscal policy has actually improved. And all those countries have started running surpluses and get their fiscal house in order. Now, if you contrast it, the next slide is going to show us the non-targeters, the 3 main non-targeters, Japan, Switzerland, and the US. And what you see is that over the same period of time, there's actually no improvement in fiscal policy at all. In fact, you see very much the opposite. Now, this is a very crude measure. We've done some more research. So the next slide is just going to give you an example of an inflation targeter using structural VAR models. I'm not going to go into the details, but what you basically see here, you see the green impulse response is for the period of 1980 to 1993. So this is pre-introduction of inflation targeting, and it shows you the response of a government expenditure shock, or the response of monetary policy. So what you see is that whenever the government started spending more, monetary policy has actually reduced interest rate and accommodated the government's running the debt. And this is in stark contrast with what happened after the introduction of inflation targeting, which is the blue line, where if the government engaged in excessive spending, central bank actually went out and increased the rate, so kind of offset the effect on the economy. And again, the next slide is giving Switzerland as an example of a non-targeter, and you see very much the opposite again. Prior to inflation targeting, and you mentioned that they had a lot of independence, and they were a traditionally conservative central bank. So we see the offsetting, the fighting the government before in the 90s, 80s, and early 90s. But after that, we actually see the very opposite. We see monetary policy accommodating fiscal shocks. Mm-hmm. Now we're re-estimating this using kind of more fancy methods, but this just gives you an idea that maybe what you're talking about, what your experience in New Zealand is, it might be generalized into a more general type of framework. But now you mentioned managing expectations. You mentioned the benefits of transparency. So if I can ask you about this, how does that work? There's this anchoring expectation that people talk about. What is it?
Well, I think it does. When we first introduced the 0 to 2% target in New Zealand, a number of people thought we were absolutely out of our mind. We'd had this quite high inflation for quite a long time. Most people thought we might, with a bit of hard work, get it down to about 5. But the idea of getting it below 2 was regarded, even within the central bank itself, as somewhat preposterous. I well recall the head of our trade union movement in New Zealand writing an article in the newspaper saying, look, this single-minded focus on getting inflation under control is nuts. It's very bad news for workers, it's very bad news for employment and so on. But unfortunately, this madman in the central bank is absolutely committed to doing it, so we really have no choice than to adjust wage and salary demands in line with that objective. And in fact, I recall having a meeting with him and the then Prime Minister in which I said, look, unemployment is going to go up if you guys keep on insisting on wage demands, which are markedly higher than the inflation target which the government and we have agreed. Because prices are going to be going up at this modest rate. If your wages are going up at 2 or 3 times that rate, the thing which gives is the employment rate. And he absolutely understood that point, and for a period of, I don't know how many months, but a number of months, he went around the countryside campaigning, so head of the union movement, campaigning for modest wage demands. Because he said, otherwise, unemployment's going to go up. And I think that was very important. I must say I'm not well typecast for this role, Jan, because I'm a nice, gentle, kindly guy. You need to be seen as a hard-nosed, miserable so-and-so, because what you've got to convince people of is that you're absolutely committed to the inflation target. Because once they believe that and start behaving in line with that, then the social costs of getting there disappear. I mean, the social costs of getting inflation down relate to the fact that people don't really believe you mean it. So they behave in ways which are conditioned by the past, high inflation, and not by the new inflation target. I once recall having a discussion with Michael Cullen, who became the Labour Party finance spokesman, and we're talking about employment and inflation. And I said, look, when you reduce inflation from, say, 10% to 2%, unemployment almost always goes up. Why? Because when inflation's 10%, wage and salary earners demand wage increases to that, gear to that expectation. Firms price things on that expectation. The general assumption that's what's going to continue. Now, if monetary policy squeezes down the inflation rate to 2% per annum, all of a sudden businesses find they can't pass on 10% wage increases, lay off staff, some businesses collapse, unemployment goes up. And it stays up until price setting behaviour and wage and salary setting behaviour adjusts to whatever the new inflation rate is. And then unemployment returns to whatever drives the long-term rate. Conversely, of course, if inflation's been trucking along at 2 and you wind the inflation rate up to, say, 6 or 8, in the short term, unemployment goes down. Why? Because real wages have gone down. Real wages have gone down. But when workers realise they've been taken for a ride, and start demanding higher wages to compensate prices, then unemployment again returns to where it was previously. And Michael Cullen said, I guess you get a bigger increase in unemployment when you're winding inflation down than you get reduction in unemployment when you're cranking inflation up. Because given our history, it's so much harder to reduce inflation expectations than to increase inflation expectations. He was absolutely right.
Well, there's a lot of evidence to suggest that wages are more rigid downwards than upwards. But now you raised the issue of credibility, which largely determines the cost of disinflation. And I recall this quote by Mervyn King at the Bank of England, and he had this nice analogy, basically saying, well, if the central bank had perfect credibility, then basically they wouldn't have to change the interest rate at all. They'd be like the referee in a game, and they just the fact that it's there, just the announcements of, okay, if you guys don't adjust your behavior, we're going to do something with the rates, would be enough for the economy to adjust the way that is needed. Now, obviously, that's the ideal situation. But have we moved from, if you compare the situation in the 1980s and the credibility of the Reserve Bank of New Zealand to what it has had, 20 or 30 years later, do you think that the gains in credibility have been in this direction?
Absolutely, I agree with Mervyn King. Funny enough, that's true not only of the economy more generally; it's also true of financial markets. One of the things which astounded me in the first decade or so of my being governor, we did not have an official cash rate as the RBA does now and as the Reserve Bank does now. We modified the total amount of settlement cash across all the settlement banks and their accounts with the Reserve Bank. And we basically ran the system on a very, very tiny base of settlement cash. And the principle was that if we wanted to ease, we would increase that slightly. If we wanted to tighten, we would reduce it slightly. But in fact, over a period of years, we didn't change it at all. Why not? Because all we had to do was say, we're a bit unhappy about the inflation rate. All of a sudden, things would tighten. It was the ultimate kind of no-hands central banking. Occasionally, of course, you had to do something because you had to make the financial markets know that you were actually serious and that you were able to tighten or loosen conditions. But for the most part, we barely touched the levers at all. All we had to do was publish a forecast for the inflation rate and say we were happy or unhappy. So it worked very well.
Now, I mean, given these benefits, and there's a lot of research showing that inflation targeting does seem to anchor expectations at the target level. Why do you think that some countries like the United States or Switzerland have not really adopted a numerical inflation target? Now, especially if you take into account the fact that the Fed chairman, Ben Bernanke, was a big proponent of the regime before he became the chairman of the Fed, and so everyone expected that he might go ahead. Can you see any reasons why?
Well, you're right. It is surprising. I think most developed countries now have a formal inflation target. The United States is the major exception to that, and Bernanke wrote a book literally on inflation targeting. I can only assume that it has to do with two factors. I don't know the answer, but I suspect the answer may be that in the legislation under which the Fed operates, the Fed is obliged to focus not just on inflation but also on employment. Now, Bernanke, like Greenspan before him, may be absolutely convinced that the only thing monetary policy can do for employment is to keep prices, the price level low, and price increases low and stable. But if the legislation is such that he's, in theory, also responsible for unemployment, then he may feel unable to adopt a framework which is so explicitly focused on inflation. I mean, I can't think of any other good reason. It may also be that there are some people who don't understand inflation targeting, who simply don't understand that it isn't the rigid straitjacket that some people try to portray it. I mean, Joseph Stiglitz, for example, has said, pity all the countries with inflation targets because it's such a rigid straitjacket that crucifies people. Well, I mean, every inflation targeting central bank that I'm aware of does specifically allow for exogenous shocks. If you get a doubling of the international oil price for the sake of argument, you're not required as a central bank governor, and any central bank I know, to so tighten monetary policy that every other price falls to compensate or offset the rise in the oil price. So if there's a genuinely exogenous shock, oil prices or change in the GST rate or something of that kind, most inflation targeting central banks look through that. But that may not be fully understood by some of the critics.
Well, in fact, if you look at the statements of the former Fed chairman Greenspan, this would be his concern about the straitjacket, about focusing too hard on inflation and letting ignoring the real economy. And again, there's a lot of evidence showing that the variability of unemployment and output in inflation targeting country has not increased compared to non-targeting. In fact, if anything, it was reduced.
Yeah. I'm not sure whether Greenspan really believed that, I have to say, because Greenspan understood as well as anyone that monetary policy does not have a long-term effect on employment. I've spoken to audiences in Jackson Hole, Wyoming, which is the central bankers' junket at the end of August from time to time, and talked to Greenspan about the fact that we have only a single focus for monetary policy, and he was green with envy. He said, I wish we had that in the United States.